Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. And I want to welcome you again to a subscriber request Tuesday series that I like to do every Tuesday. And before I get started in the actual video, though, I do want to give you guys some perspectives here. These are not companies that I'm necessarily recommending them. I'm not picking them because I'm recommending them. I'm choosing to show these companies because they're companies that you, my valued subscribers, asked me for. And I think that's important because what I'm hoping I'm going to accomplish by going through this subscriber request process here is give you some insights that you might not have had prior to me going through these companies and kind of running them through the FastGraphs Fundamentals Analyzer software tool so that you can see the real characteristics of these companies, how they've performed as businesses, as well as how they've performed for their shareholders. And I also want to basically illustrate how they're performing from a standpoint of valuation, because that's a critical part of what I do. So let's go ahead and get into the video. Let's look at, I'm calling this particular series today Brand Power. I'm looking at about 14 of the top brands in the United States, and these are all US-based companies. I want to make that clear, but these are all recognized brands. All of these companies have what I would call brand power. And we're going to start with General Mills, the cereal company, and I kind of want to, use this one. I like this one because it kind of really is a quintessential, what I would call FastGraphs, Mr. Valuation value type of stock. Because first of all, the intrinsic value formula is what draws the orange line. And this has a normal or regular, what I would call a classic fair value of 15 times earnings, which is an earnings yield of 6.67% if the stock trades at that. Now, one characteristic you'll see as I go through these companies, and I'm going to go through them rather quickly, is that the market likes to put a premium valuation on these stocks quite often. And that's, I think, attributable to their brand power. Because what you're also going to find out, these aren't the fastest growing companies on the planet. Now, in the case of General Mills, it's not too bad. Its historical earnings growth has been about 6.09% since the beginning of 2001 here that I'm showing on the graph. You can see that they've had a steady increase in their dividend. And if I go ahead and look at their performance real quick before I go on, you can see that the company has performed pretty consistently with its long-term growth rate. Using this long-term, view here, they've had about 5% capital appreciation. They've generated a lot more income than the average stock in the market. And they've come out almost close to what I'd call a dead heat with the market when you combine income with capital appreciation. But they're heavy on income and a little light on capital appreciation. So that's one thing that is, that you want to understand. But another thing I like about this stock is, notice how we get the valuation importance here that I always talk about. Every time this stock gets above the orange line, it tends to revert to the mean. Sometimes it lasts for a couple of years, and this was, of course, the Great Recession. Then it stayed at that fair value. Then it got really overvalued, and everyone really loved this stock for a while. And noticed that there was nothing special about their growth here, growing at 5%, 1%, 2% back in this time frame. But the stock got overvalued, and then we had this massive correction where the stock, fell precipitously and actually became undervalued for a period of time, which I might add is when you should have been buying the stock. And then more recently, it's been, again, vacillating along this orange line, but it gets above it and below it and above it and, right on it, and then it's slightly above it right now. So I would call this stock a little expensive. Earnings growth of about 6%. It has a BBB credit rating, 42% debt to capital. A decent company that if you buy it at a good value, it's really what you're buying is the quality. But you want to be very careful because you don't want to invest in this stock when the valuation is high. Because even with this high valuation, your rate of return over the time I measured here, which was July of 2013 when the PE was 19, you end up with a 5% rate of return, and that includes dividends. By the way, I want to make it clear, as you can see, at 10,000 grew to 11,565. That's not very much growth. And there was a roller coaster ride in between that, which makes stocks very hard for people to own. So there's General Mills for you. Now, I'm going to try to stick around, as I go through this in categories. Here's another cereal company, of course, Kellogg. And, Tony the Tiger might think Kellogg is great, but its average growth has been about 4.47%, BBB rated with 62% debt. And once again, you can see that the price follows earnings, but we also see this penchant to put a premium valuation on the stock, which I can only attribute to brand power. I don't think this company's worth 17 or 18 times earnings, which is what the blue line here is. But yet there are many, many times where the market will value it at that high valuation. But then, if you get into a little bit of trouble like we did the Great Recession, then that 15 PE ratio that I talk about all the time seems to rear its ugly head again. Once again, the stock got very expensive, just as we saw previously with General Mills. It reverted back to the mean, and once again, we've got a stock that's trading here. So when you're looking at it from a performance perspective, average capital appreciation over this time frame has been 4.5%, did produce a lot more dividend income than the market. And again, the attraction here would be the 3.62% dividend yield. And, that's close to the 3.39 we saw with General Mills. So what's attractive about both these cereal companies would be their current income or their dividend. Their dividend growth rates have mirrored their historical growth rates, about 4.4% for Kellogg. And if I go in here to General Mills over the same time frame, it's been about 7%. So it's been a little higher, but they actually have frozen their dividend for 2018, 19, and 20. So you always want to look at all these things when you're evaluating these stocks. Now, the next company I want to go to is really a quintessential example of what I've been alluding to here, and that's, of course, Colgate Palmolive, which is AA- rated, does have an awful lot of debt. Okay, and I'm going to cover something about that here in a moment, but the market likes to put a very high multiple on this stock. And I want you to notice with about a 6.6% growth rate, if I look at its historical performance, it's underperformed its earnings growth. It has produced more dividend income than the market, but I want you to note that this was very highly valued back in 2001. The PE was actually 34. All right, so if I shorten this time frame by a couple of years and get it to where it had this 20-ish PE ratio, which the market likes to put on it, now my performance is about 7% again, but again, it underperformed the market, but it outperforms it on a dividend income. That's really the attraction to these stocks. But you're paying a very high valuation. Notice that, from this period of time right here, there wasn't a whole lot of growth in the company. These aren't growth stocks, they're primarily income vehicles. But, people like consumer staples for the quality, the high credit ratings in the case of Colgate, and the dividend, notwithstanding the fact that they got high debt. So let's go ahead and look at operating cash flow in this example, because that's going to be all about dividend coverage. With Fast Graphs, I've got all of these choices, but the things I like to look at for these income stocks is the operating cash flow and the free cash flow. So let's look at operating cash flow first. Now, as you can see, this stock trades at around 18 times operating cash flow. It's even highly valued on that basis, but that's really not what I wanted to focus your attention. I wanted you to see that the operating cash flow really heavily covers the dividend, despite the fact that the company has a lot of debt. And then, of course, the acid test that I like to do with stocks like this is then look at free cash flow to see if free cash flow is also covering the dividend. And once again, we see that the company's free cash flow is covering their dividend. So that's why these, very stable, high-quality rated companies seem to be attractions for investors. They don't perform. Their performance isn't necessarily great, but they are stable, consumer staples with good quality and certainly good brand identification. Next, I'm going to go to Kimberly Clark, household products, diapers and paper goods and so on. And once again, we see about a 4% growth rate, not a whole lot of growth. We see this penchant to put a premium valuation at around 16 to 17 times earnings, but we also get the opportunity to buy this stock quite often at the 15 PE. One of the messages I want to get across here is that I really believe if you're going to buy these consumer staples, because they don't grow very fast, you really, really want to be disciplined and only buy them when their valuation is attractive. So let's look at the long-term performance here as an example. And there's a pretty high valuation in the beginning here. The PE is about 18, slightly higher than it is now. Now, it does offer a 3.5% dividend yield because it's come back down to that, right around that normal multiple that the market likes to put. But when I look at performance here, I see only 3.3% capital appreciation, only 5% total return counting dividends. But I do see, again, another example of a business that has produced a lot more dividend income than the average stock out there. But watch what happens if I can just buy it at around a 14 or 15 multiple, like wait a year, or in this case, almost 2 years, then I increase my rate of return to over 7.5%. And that's, significantly better than the 5% we saw when we overpaid for it. So you want to be very careful with valuation when you're dealing with these stocks. Mondelez International, now this stock has gone through a lot of divestitures, acquisitions. They were merged with Heinz at one point and so on and so forth. So I'm going to shorten the time frame on this one and kind of get past that and look at it as closely as I can through its what I'll call its current iteration here, which is, really where it's been operating. So I'm going to trim that all the way down to the beginning of 2011. We got about a 7.5% growth rate. Once again, premium valuation on the stock. It's BBB rated with only 36% debt, so I kind of like that. When I look at this one from a standpoint of operating cash flow, I want to get a perspective of valuation as well as, dividend coverage. And once again, we see the dividend is well covered, but we see a little bit more of an erratic picture here when I look at operating cash flow. That's just something for you to think about. But the bottom line is, this particular company, once again, has performed kind of consistent with its growth rate, produced more income than the market, underperformed the market slightly in capital appreciation, which again is the characteristics of these consumer staples. Campbell Soup is only a 2% grower, and I find this company very, very interesting because I think this really tells you a lot about brand power. You can see how the market loves to put a very high valuation on this stock, despite the fact that we don't get a whole lot of growth out of it. And we've even had times when they've put these extreme valuations up here in the 20 multiples. And of course, that led to a significant drop in the value of the stock, especially when their earnings turned down a little bit. But when I look at the long-term performance here, I barely, just slightly more than break even. 10,000 turns into 13,000 over this 20-year period. Does pay more income, but underperformed the market on a total return basis. And again, valuation has an awful lot to do with that. But you buy a stock like Campbell Soup when the valuation is real high, like, you could have back here, and your rate of return drops down to about 2%. You got to be very careful with these stocks and only want to invest in them when you can buy them at very attractive valuations. And to me, I believe you should patiently wait for those valuations to come to you. Coca-Cola is another example. Obviously, I always talked about how Warren Buffett bought it, but, let's look at what Coca-Cola really has done. It's only grown at 5.5%. It is A+ rated, I'll give it that. It does have a lot of debt. The market likes to value it in the 20 multiple range, but, the only time we could have bought it at a lower valuation was during the Great Recession. If I look at it from a standpoint of long-term performance, now I'm measuring it here when the valuation was very high during the irrational exuberant period. So with 5.51% growth, over all these years, I'd have averaged 2.9% capital appreciation. I would have generated more dividend income despite the high valuation I paid to buy it than the market. But again, I underperformed the market over this time frame, owning Coca-Cola, which is one of the most identified brands, obviously, in the world. Now, had I been able to buy Coca-Cola when it was trading at a 13 multiple during the Great Recession, my rate of return over that period of time would have been double digits. Valuation matters a lot, and it really matters when you're dealing with lower growth companies. Now, what's interesting is to compare that Coca-Cola to one of its major competitors, which is Pepsi, which has grown at about 7%. Again, very highly valued, coming through the recession of 2001. I do want you to notice Pepsi has had a great dividend record. Earnings have held up because they also have the snack foods, etc., despite, the fact that we went through a recession. That's important. But once again, their performance about 5%. They did generate significantly more income than the market, and they came out almost at a dead heat with their performance, starting out with a very high valuation. Now, if I shorten this time frame, I'm going to shorten it one more year here, and I get it to where it's a little closer to what I would call its normal 20-year multiple. Here I've got a 6% growth period of time, and I've got a 6.5% return and blown it up to 8%. But again, I outperformed the market. So even buying it at a better valuation and ending up with overvaluation, which I believe Pepsi's in right now, didn't help much. But once again, if I could have bought it when it was attractively valued, and I won't pick the bottom there, I could shoot that up to a double-digit rate of return, given the fact that it's also overvalued. But that's what's happening with these big brands. They don't grow a lot, but Mr. Market likes to put a premium valuation, which says if you want to own them, you got to be willing to pay up. Now, the final one I'm going to do is Keurig Dr. Pepper, which is the coffee, company combining with Dr. Pepper, which was spun off. And the reality of it here, this one has grown at double-digit rates, so it's been one of the faster-growing stocks. It's triple B beta with only 32% debt. There was a long period of time you could have bought this at attractive valuation, and then more recently, it's gotten really overvalued. But I do want you to note that their growth rate has accelerated dramatically here. So if I shorten this to about a 7 or 8 year time frame, let me actually shorten it one more year here, you can see we're ending up with about a 15% growth rate, and a 20 multiple. So during this time frame, I would have beat the market, even though this was a very opportune time for the market. And I even produced more dividend income because here we had growth, and growth is what gave us the valuation. Over the long run, going back all the way to exception when the stock was fairly valued, and we compare it to the market, we dramatically outperformed the market and got dramatically more income because valuation matters, and it matters a lot. But right now, I do not consider this an opportune time to buy Keurig Dr. Pepper. The next one would be Hershey. Hershey's is absolutely a classic example of what I've been talking about throughout this video. The market always puts a premium valuation on the stock. It's almost never traded at what I would call a fair value. Now, it does grow faster than most of the ones I've showed you, about 8.5%. You can see it was slightly overvalued here with a PE of about 24, close to what it's trading at now, a little higher valuation than that. So we're going to get a capital appreciation that's going to be pretty close to that 8.5%. We get it, right on the money, actually, and then plus dividend income. It ended up outperforming the market over this time frame and significantly outperformed it on dividend income. But again, the key factor here is that we got a very strong 8.5% growth rate over this time frame and a very, very consistent growth rate. And the dividend income has also grown at actually slightly above its growth rate at about 9% a year. So Hershey's has been a great investment. It's A-rated with 61% debt. You've got to be willing to pay up to invest in this. So if we go, look at it from an operating cash flow, I'm only selectively looking at operating cash flow here, not with every company, you get a little bit clearer picture of maybe valuation with operating cash flow. But once again, the stock looks overvalued. But the key factor is here, operating cash flow clearly covered their dividend. And so let's look at free cash flow for dividend coverage as well. And we see a not as clear, as pristine a picture. We've seen, generally speaking, their free cash flow has at least covered their dividend and in many cases exceeded their dividend. So I would give Hershey good marks for that. It's A-rated company. Next, I want to move on to Hormel, the meat company. And I really find this one kind of really interesting because most of the time, again, we get a 15 to 19 multiple. You can see that the stock for all these years traded clearly within that range. Then we had this irrational, market that I keep harping about, where stock prices have really got extended. You can see a significant break. I mean, this is a pretty significant, change in value here. This is a 28% drop in value, from March of 2016 to October 31st of 2017. So you can see how much trouble valuation can get you into. The stock is significantly overvalued today. It's A-rated, only has 13% debt. All right, now from a performance point of view, it was fairly valued at the beginning here. It grew at 8.73%, which again is one of the fastest I've shown so far. But look what happened to the rate of return here. We ended up with 12% capital appreciation, almost quadrupled the income, more than tripled it, I guess you would say, of the S&P 500, and virtually doubled the rate of return that the market generated, turning 10,000 into over 100,000. So, if you're willing to pay the premium, you could have made a lot of money in Hormel, but a lot of that is baked in to the high valuation. If I would take this and value it at what I would consider intrinsic value, my rate of return would drop to 10%. Okay, which means this is a significant potential fall off that you could have there rather than, the 13% that we see, that it is historically done. So you always want to pay attention to valuation when you're looking at these. McCormick, another classic example, 8.5% growth, BBB rated. This is the spice company, McCormick, that everybody has in their house. You can see the market likes to put a premium valuation on it. Occasionally you could buy it when it's attractive. I'm willing to wait patiently to buy these stocks when they're attractively valued, because to me, this is where you can really make good money owning these stocks. Nevertheless, if I look at the long-term performance here, it's averaged about 11%. A lot of that baked in with the valuation we have, generate a significant amount of dividend income. And, currently, though, the yield is only 1.57%. So I should also add that to my valuation perspective here. If you look at this stock from a standpoint of when you could buy it when it's attractively valued, you get really nice yields of, approaching over 2% and even up to 3%. So a 1.5% dividend yield tells you the stock is really heavily valued right now. And then last but not least is Church & Dwight, which is the Arm & Hammer Baking Soda, BBB plus rated, only 35% debt, very, very consistent performer. You can see they've increased their dividend payout ratio here recently. Really a terrific company. $10,000 investment would have grown to over $226,000 over this time versus only $33,000 in the average stock, compared to the index. But again, massive overvaluation here. And even though we have really good quality, really consistent growth, you want to be very careful paying this kind of valuation. At some point, this bear market ends, because look at all these years prior, between the last two recessions where this stock did trade down. So if this goes down to a 22 multiple again over the next year or so, that's about a 13% drop in value. If I look at it longer term, this could end up being a negative rate of return company if it trades at a 15 multiple. It has to trade at these high premiums for it to generate any money, and that's just a lot of risk that you're taking. Anyway, this is a subscriber request. You asked for them. I've shown them to you. These are some of the biggest, most widely known brands in the United States domiciled companies here. Hope you got a little better perspective of how they operate. If you liked the video, please give me a like, ring the bell, subscribe to the channel if you already haven't, and give me a thumbs up. I appreciate you guys, and I look forward to talking to you again with the next video. Thanks for watching.